Hello, everybody, and welcome to another video on financial analysis with me, Ted Wainman. And today we are going to be looking at BP. Now, I am sure that BP does not need any introduction, but if you've been hiding under a rock for the last few years, then BP is a British multinational oil and gas company headquartered here in London, England, London, United Kingdom. And is one of the world's 7 oil and gas supermajors. So this is a big market player. And today we are going to be looking at their financial statements. Now, the financial statements we're going to be looking at are out of date. We are now in January 2022 when we're recording this, and the financial statements are dated the year end 2020. We will be looking at their third quarter update as well, but this is out of date, but it's just going to give us a feel for the company, how they were performing in 2020, and also opportunity to look at their share price, what it's been doing recently, and to see whether there is value to be had in this company. So without further ado, let's dive in and have a look at their financial statements. So here we go. Here are the financial statements. Performing while transforming, obviously very much on the green agenda for these guys, but they are one of the dirty. You know, they are producing fossil fuels, and we need fossil fuels. Even if you are driving an electric car, you're going to need fossil fuels in order to drive the manufacturers who actually make those electric cars. So big need for fossil fuels in our economy these days, and we're now going to look at their financial statements and see what is going on in this company. Okay, so here we have the group income statement up in front of you. We are dealing in millions of dollars. Okay, so just so we're absolutely clear, we're looking at this number here. There we are, millions of dollars. And so the total turnover for the company is 183,000 million. That's nearly 184 billion dollars. But look at this, the revenue from the previous year down significantly. Now they're kind of splitting out between other joint ventures. You can see the top line, that's really where their core business is coming from, which is effectively oil and gas exploration, exploring, finding it, getting it out the ground, and then selling it. So very significant top line, off by about 35% 2019 to 2020, very much reflected in the pandemic. Many of you will remember the price of oil went negative in some places in the world in 2020 as oil producers were producing lots of oil. Nobody was consuming it because the world was in lockdown due to the pandemic, and therefore they had nowhere to store it. So I think it was the West Texas went negative, although I have no doubt that somebody watching will correct me on that and tell me that I am wrong. Big costs to them are their purchases, and then lots of other costs. And what we see for these guys is in 2020 they're booking a great big loss, 22 billion loss, compared with a 20 billion profit in 2018 and an 11 or 12 billion profit in 2019. Now, a lot of that loss, not only there's kind of a lot of it is driven by this big reduction here due to the price of oil falling significantly, and also, you know, just the contraction in demand for their product. But also worth just noting here, we can see there's a very big loss on exploration. So this is effectively what's happening is that a company like BP, they will explore for new oil fields. They'll capitalize those exploration costs. What they'll do is effectively say, we spent, you know, $1 million looking for oil, and we capitalize it, and then we recognize that cost of exploration when we start extracting the oil. And what they're really doing here is saying, look, you know, we couldn't find any oil, therefore we've decided we're not gonna we're going to uncapitalize it, effectively, for want of a better word, and write it off. So that's a sort of a bit of a one-off. You see, it wasn't in there in previous years, and it's probably not going to be there in future years. I'm slightly thinking that they knew 2020 was going to be a bad year. They're going to make a loss anyway, even without that big 10 billion write-off. And so this is really a good opportunity to bury bad news. So I wouldn't be surprised if Bernard Looney at the top would have just said, look, we're gonna have a rubbish year, throw out all the trash. This is the time to kind of clear out all the nasties in the business, and then 2021 is going to look a lot nicer, and we're going to come back, really, back to strength, etc., etc. Anyway, so bottom line is for 2020, they made a $21 billion loss compared with a small $4 billion profit, down from 2019 of a 2018, should I say, of about a 10 billion profit. Do note that they've got some debt here, so they're obviously paying interest, so they do have some debt sitting on the balance sheet, and that's really it. And I guess the other sort of big thing to notice is that there's a very big depreciation, amortization, depletion and amortization. So don't forget, these guys, they are exploring, they're finding opportunities to drill oil wells, etc., etc., oil fields. They're then sort of setting it all up, they extract it. It's very capital intensive business, and then when they finish and at the end of the oil rig's life, they can't do the good old days like just towing it out to sea and sinking it. They've actually got to dismantle the whole thing, and that comes at a cost as well. So there's going to be a large amount of kind of depreciation, amortization charge for an organization such as this, and you can see that's $15 billion. The production and manufacturing expenses, that'll be things like oil refinery. So they'll own what they call downstream activities. They get it out the ground, and then they have to refine it before they actually sell it onto the market, separate it into the different types of petrol that you can put in your vehicle, and then all the way really down to the forecourt, for example. And then a little bit of admin down the bottom. I say a little bit of admin, 10 billion, but that's still a reasonable amount. And the purchases will be, buying a lot of the services, etc., etc. So there we go. It's a 20 billion loss, and we will have a look at the latest kind of set of accounts in a minute. But before we do that, let's go on and have a look at the balance sheet. We can just find the balance sheet. Here it is. So the balance sheet. In the balance sheet, these are the non-current assets, the assets that we need to run the business, and the big number very much is property, plant and equipment. As we said, very capital intensive business, $115 billion worth of kit, and that'll be all the sort of the oil rigs and the pipes and the drill bits and just about everything else, etc., etc., and quite a lot of investments in other businesses as well. A little bit of goodwill in there where they purchased other companies in order to continue their expansion. So these are the fixed assets, 163 billion, nearly 164 billion. They've got some, they split these ones out for some reason. I'm not sure exactly why. These are kind of, other forms of assets, and then they've got their current assets down the bottom. Current assets are things which are cash or going to become cash soon. Now you'll notice that they are sitting on a very significant cash pile, $31 billion. They've got quite a lot of inventory, so that will be predominantly oil sitting in possibly in oil fields, so their reserves, but also it'll be sitting in tankers shipping around the world, and they've got some trade receivables, 18 billion, which is owed to them. So there are the assets. So the kind of it's interesting, we don't often see this. So we've got the non-current assets plus kind of other bits and pieces, and then the current assets as well. And the current assets make a total of, well, there's 71,656 plus a little bit of assets classified for sale. So the total current assets are 72 billion. So our total assets, 268 billion. That's the current assets here, which is these numbers all added together, and the non-current assets, which is effectively this is a little sort of subtotal of all of these numbers, and then we add that number to these numbers here to get so those two numbers are added together to get to 195 billion. So let's go and have a look at the liability side, see if there's anything jumping out at us, and on the liabilities we see, first of all, they've got the current liabilities are about 60 billion, so that's this number here. So 60 billion, again, we can just do our quick liquidity check. So 73 billion of current assets, that's things which are cash or going to become cash soon. 60 billion of liabilities that they have to pay soon. You can see the biggest number there is their trade payables. They've got a lot of cash sitting in the bank, so liquidity really doesn't look like a problem for these guys. And then they've also got some of this short-term debt. This is probably long-term debt, which is now falling due, and that's not a problem for these guys because they're just going to refinance. And then down the bottom, in the non-current liabilities, big number jumping out of us is the debt, and we see, you know, they're paying interest, and they're paying interest whatever it was, about $4 billion, $3 billion, I think, in interest. They're paying $3 billion in interest because they've got 63 plus another 10, so about $73 billion of debt sitting on the balance sheet. Few other provisions, so these will be things like the provision for the dismantling of assets when they no longer use them. So once an oil rig has run its course, they've then got to basically take it apart and dismantle it in a kind of environmentally friendly way, and they've put $17 billion aside in order to do that. So that's a regulatory reserve almost for these guys, and that's really kind of the main numbers there. So we can see that the total liabilities 182 billion, total assets 268 billion, and that leaves them with net assets of 85 or 86 billion. So the net assets of the business are about $86 billion. So pretty big company here. And we see the shareholders' funds there is 86 billion as well, the balance sheet balances, which is good. So balance sheet looks pretty strong to me. Yeah, so they've been trading, they've made a loss, they've made a profit in the past. We kind of expect them to be making a profit in the future as the oil price comes back. Oil price right now is reasonably strong. We'll just have a look at the movement in equity. So this is the movement in equity, and we can see we're just we're looking at this column here. This is the profit and loss account, and we can see there's the profit, or in their case the loss for the year. They're maintaining their dividend. The previous year they made a profit. There's the 4 billion of profit, and they also paid out a dividend as well. You can see down the bottom of your screen. So these guys, they've been paying dividend. Now they have cut the dividend. They cut it a while ago, a few years ago, and their aim is to continue to be able to pay that dividend. So if you're an income investor, if you like your dividends, then these guys could be a good option for you. Could, obviously, with that sort of normal caveats coming. Cash flow, quite interesting on the cash flow. So even though making a loss, they are generating cash. So very, very strong cash flow, and quite consistent strong cash flow. 23 billion in 2018, 26 billion in 2019, and 12 billion in 2020. Now, why are they generating so much cash? The main reason is, first of all, we've got this big depreciation charge, and then we've got there's an impairment charge as well, and both of these are effectively non-cash items. So they've made a loss on them, but it doesn't actually affect their cash position. And then, as we mentioned before, you remember that exploration write-off costs. Again, if you've capitalized some costs, you're no longer going to actually, you're no longer going to explore that area for the oil field, for example, and you just write it off. It doesn't affect your cash. So underlying, the core business is still very, very much generating cash, and we like companies that generate lots of cash. So we got the second part is the investing activity. So this is kind of the capex. So lots of investment going on. Here we go. So they're still spending, look at that, 12 billion on property, plant and equipment, compared with 15 to 16 billion in previous years. So still lots of investment going on in this business. They're not going anywhere soon. And if we scroll down to the bottom of the cash flow, we can see the effect of financing. Here we go. And we can see, first of all, jumps out at us is that these guys are refinancing their debt each year. So they're just rolling over their debt. Little bit of share buyback going on, not excessive, but just a little bit. I'm not sure exactly why. They're just indulging in a small amount, and they've issued some debt as well, some perpetual bonds. So these are bonds which will never have to be repaid. They just pay an interest or a coupon in the case of a bond forever. And then we can see the dividends being paid out as well. So some really nice, consistent dividend payments going on, and still they end up with a ton of cash sitting in the balance sheet. So these guys, you know, they're generating lots of cash. They are investing in the future of the business. There's a little bit of financing. They've upped their debt a little bit. But you know, it doesn't look like it's out of control. And as long as the oil price comes back, which it has done, and as long as the kind of the post-pandemic recovery kind of stays on track, no reason why these guys shouldn't be clearly benefiting from it. Now, the problem that BP have is obviously with the kind of the perception of, you know, this, you know, we're all about, you know, clean energy and electric cars, and you know, that's the future, and these guys, they're dirty, they're horrible, they're sort of fossil fuels. And if you remember, Lord Brown tried to kind of, you know, rebrand it as Beyond Petroleum, probably a little bit ahead of his time at the time. You know, BP making big investments in trying to rebrand itself and kind of, you know, sort of get into that green energy. And then a lot of investors are saying, can you split it out? Can you have the green over here and the dirty fuels over there? And then Bernard Looney will say no, because we need to make money on the old stuff so we can invest it in the new stuff. So these guys are, you know, they're planning to be around for a while, but they do produce dirty fuel. And much as we may not like it, you know, that powers the world at the moment. So, you know, while you may kind of, you know, question the ethics of investing in BP from a purely financial opportunity, this looks like, you know, it's a good, solid business. So let's look at the share price and see what the share price has been doing. This is a kind of, you know, all the way back into the sort of, you know, 1980s. It's been bouncing around. You see it, it went up quite substantially. It's bounced around. It's kind of come off the boil, but recently it has been coming up. It's hit its kind of nadir, the bottom. That'll be the kind of 2020 bottom, and since then it has been rising. So look at this market cap, 72 billion. Now market cap, let's just remind ourselves of that. So the market cap, this is a company with a balance sheet. Here's the balance sheet. The net assets are 85 billion. So in theory, and I emphasize in theory, if you were to buy BP, you could buy it for this existing share price of 72 billion. You could then effectively just break it up and sell all the assets net of the liabilities for 86 billion. Not quite as simple as that, but that's kind of the theory. This is trading at below book value. So, you know, this looks like a very, very cheap company compared with some of the tech stocks that are out there that are experiencing a few headwinds at the moment. Which are, you know, they're all goodwill. You know, this is a discount. This is trading at a discount. Price to earnings ratio, well, you've got 15 times earnings. Now you could say, hold on a sec, Ted, it's got a loss. So where does that one come from? Well, absolutely, it is making a loss. But of course, if we were to look at the latest set of accounts, and here is their quarterly. So this is their 9 months to released in November, but 9 months to the end of September. And we can see the third quarter 2021. So we're looking at this third. Well, actually, we're going to look at this one here. So this is the 9 months, and we can see that the profit they've made for the 9 months, they're back at 5 billion. Now, for the quarter, they did make a loss. The second quarter, they made a healthy profit, but the 9 months, this is really what we're interested in. They made a $5 billion profit, compared with, there you can see the kind of, you know, the nightmare they were having in 2020. So $5 billion profit, and if they can kind of replicate that for the last few months, no reason why they shouldn't be able to. Then they should be, you know, somewhere around $6, maybe $7 billion of profit. Again, you know, strong cash flow coming through. So, you know, all of this is kind of, sorry, I got the wrong one. Here we go. So strong cash flow coming through. you know, we kind of back up. They're paying out their dividends. They're investing in the future of the business. So, you know, lots of kind of positive numbers are coming through there. So that is really driving the price to earnings ratio. So our price to earnings ratio, let's just remind ourselves what it was. Here it is, if I can just find it for us. So the price to earnings ratio, there it is. It's 15 times earnings. So, you know, 15 times earnings, that's a kind of, you know, that's a sort of 7% yield. The dividend yield in itself is 4%. So if you buy this share and assume that the dividend stays constant and assume that the share price doesn't go anywhere, then you're getting a 4% return on your investment, which looks pretty good. So you're not going to make your fortune overnight. This isn't one of your kind of, you know, 50 million baggers or whatever, or where you kind of, you know, win the lottery and that's it. And there are companies out there which I'm sure some of you will be invested in and will be kind of, you know, holding on and praying each evening for kind of redemption. But this is, you know, this is, you know, part of a well-diversified portfolio. It's not overly exciting, but it's gonna, you know, it's going to keep you alive. This is a sort of, you know, long-term player. This is one of what you might call a kind of, you know, just bag it in and don't worry about it. Don't look at it on a daily basis. So there's BP. Hopefully you found that a useful analysis. Once again, do please like, share, subscribe the channel. Do give me any comments, any requests you'd like me to look at. I do get lots and lots of requests, so I apologize if you have been requesting and I haven't managed to get back to you. As I said, do like, share, subscribe, and leave any comments you can to provide additional knowledge or, you know, anything research you have about BP or any of the other videos on this channel. So thank you very much indeed, and I will catch up with you soon.